that I think to say that there isn't the sign of leverage speculation in the market, and you're pointing just to margin debt, either you're being disingenuous or you're just not aware of the extreme speculation that's been going on in the options markets regularly. We've seen it mainly in the semiconductor space lately. Just look at stocks like Nvidia, of course, but more recently, Micron in the last few days has seen its stock price explode. Kind of in line with massive trading in, so far out of the money call options and short dated that expire in a day or two. So, the speculation is there. And I think, valuations have only ever been this high at the peak of the 2020 bubble. We're almost 50% higher on the things like the Warren Buffett yardstick, 50% higher today than we were at the peak of the dot-com mania. So valuations are extreme. We have extreme leverage speculation on the part of traders. And I think that, if we do get this slowdown in the economy, that will be the bearish catalyst for another, significant decline in stocks.
On this episode of the What the Finance podcast, I have the pleasure of welcoming back Jesse Felder. So Jesse is the founder of Felder Investment Research and a host of the Superinvestors podcast. So Jesse, thanks so much for coming back on the podcast today.
Good to be back with you, Anthony. Thanks for having me back on.
No problem. Look forward to speaking. I was just saying before we got on air that last time we spoke was sort of when bond yields were blowing out and we weren't sure what was going to happen. Lots of obviously debt being printed by the US Treasury, but they found a way to resolve it. So I'm sure we'll talk a bit more about that later. But at the moment, I guess, what is your opinions, just a broad overview of what you're seeing in the economy and markets in general?
Well, I think there's generally a very big divergence between the direction the economy is headed and what's priced in especially into the stock market, right? I think, we've heard about a lot of talk of a soft landing in the economy. A lot of talk about, a Goldilocks economy where, inflation's not too hot, but growth remains robust. And, this allows the Fed to lower interest rates and everything is peachy. Now, I think that what we're really seeing in the data, though, is a clear slowing in the labor market. We're seeing slowing in economic activity. The ISM number that came out this week shows manufacturing's coming back, but there's kind of been a difference between the services side of the economy and the manufacturing side. And services seems to like it keeps slowing, and that's the majority of the economy. That's really dependent on consumer spending. And so it looks like economic growth continues to slow. At the same time, inflation continues to kind of surprise on the upside. And so to me, that's stagflation, right? Slowing economic growth, still threatening, recession. At the same time, inflation remains elevated or is showing signs of turning higher. So I think we have a real risk of kind of a stagflationary thing going on in the next several quarters. And that's very different for what markets have priced in, or at least the stock market is priced in. I've heard not just Goldilocks, but platinum locks economy is what kind of the stock market is priced in right now. So I think there's a lot of room for disappointment on both the growth and the inflation side, which would cause problems for the Fed in terms of being able to cut interest rates, and especially for investors if they're not able to support the economy in that way.
Yeah, it's a new one. I've never heard of platinum locks. I guess when the market does so well, you have to come up with new people have to come up with new ways to explain it.
Right.
So that's interesting. So you're seeing, because I guess this is something that maybe we've seen over the past year or two, where economic data is probably not looking as strong as everyone thinks. That we're concerned that something like this could happen, and then somehow something gets pulled out of the hat, and things go higher. So I guess why do you think this time would be different?
This different than what? I mean, different than the historical pattern. It would be if we didn't have recession. If we actually did have a soft landing, that would be different, right? And so, what's amazing to me is how often people come around to this idea of this time is different when everybody knows, John Templeton famously coined those 4 words, the most dangerous words in finance. But I think markets are betting this time is different, that this tightening cycle will not lead to a recession, and that inflation will come down to the Fed's target without a recession. That's never really happened before. So I think what people are betting on is that this tightening episode is different than every previous one we've seen in the last at least half century. And so I think that is probably where markets have priced in an overly optimistic scenario. And I think there's a good chance that we see continued labor market weakness and a recession. And we're already seeing another data point, I think, that's pointing in this direction is the revisions in the data. Generally when we're seeing the revisions, they're pretty bearish in terms of, revisions in the employment numbers and these types of things are all kind of suggesting that the economy is slowing more than the impression that we got, in getting the data in real time. So I think that, to think this time is different and that we're going to actually pull off a soft landing, I think is probably overly optimistic.
Yeah, it's a good point. And I think maybe people have been predicting this recession for past 2 years, and there's lots of false starts potentially. And then, as you said, people are becoming disenfranchised with that and thinking maybe this time's different, and that's the peak moment when normally it isn't, and it comes back to bite everyone.
Yeah, absolutely. I mean, it's those sentiments, right? What if you're a true contrarian, I mean, I'm naturally a contrarian. I've worked on Wall Street, but never on Wall Street, right? And I try and stay as far away from the thinking as I can, because as the more time you spend in markets, the more you realize the consensus is almost always wrong. And so when the consensus was for recession, and the consensus was very bearish at the end of 2022, that was a very good contrarian signal that the economy was probably not going to go into recession because everyone was expecting it, and that stocks were overpriced. People had gotten undervalued at the time in the short run, not longer term. But that technically, stock market had become oversold and people had gotten too bearish. I think we're in the opposite situation today, where everybody has written off the possibility of a recession, and the consensus is for a soft landing, and the stock market is very overbought. To me, I think it's very clear that we're still in a stock market bubble that's persisted for several years now. And two of the things that I point to, the biggest danger signs I look at the stock market right now, are the fact that we've had 50, from a technical standpoint, not only overbought, but we've had over 50 Titanic signals triggered in the market over the last 12 months across the New York Stock Exchange and the Nasdaq. Those Titanic syndromes are a very clear warning sign about the stock market breadth, and it's only a handful of times over the past 20 years when we've seen this many Titanic syndromes trigger over that period of time. So it's just a sign that underneath the surface, the stock market is very weak. Breadth is very poor. At the same time, this insider sell to buy ratio, I'm talking about corporate executives and their insider activity, their trading activity. The sell to buy ratio in terms of the dollar amounts that they're trading, we're seeing 50 times more selling than buying right now. And in the history of my data set, it's never been that high. The closest we've ever gotten was 38 in November of 2021, as the market was peaking and rolling over into that 2022 bear market. Insiders sold 38 times as much as they purchased. Today, they're selling 50 times as much as they're buying. And in aggregate, that is usually a very good sign that stock prices are overbought, and expectations for earnings in the economy are too high. And so with those technical warning signs and insiders, behaving in such a bearish way, I think it's very important to be cautious on the equity market right now.
So what is the Titanic syndrome that you mentioned there, or the sort of signal that and what causes that?
It's very much like a Hindenburg omen. These two are, signals that basically are triggered when the stock market is within a few days or a few percent of a 52-week high, but the number of 52-week lows on the exchange are also rising significantly. So you have to have a certain amount of 52-week lows. At the same time, the market itself is at a high in order for these signals to be triggered. And so a Titanic syndrome is triggered when you have, I think it's within the stock market, whether you're looking at the New York Stock Exchange composite or the NASDAQ composite, has made a new high within the last several trading days. And the number of 52-week lows on the exchange is also above a certain threshold. So it's just a sign that there's a lot of weakness below the surface of a stock market, which otherwise looks like it's doing great because it's hitting new highs.
Okay, makes sense. And is this looking like, I guess, what we saw at the end of 2022, where, as you said, there was concern about a recession, and then sort of the markets took a hit, or do you think this is completely different? What would you compare the current market to, if you could?
Yeah, I think it's very similar to that 21-22 period, where in 21 we had very clear speculative blow off, speculative euphoria across a number of assets. Right, we had all the meme stocks in early 21. It was GameStop and things. We had crypto really took off with a lot of the not just Bitcoin and Ether and things. It was, a lot of the other just ridiculous Dogecoin and things that were going through the roof. I think we've seen a lot of speculation in the market again over the past several months. And people point out and say, well, margin debt has not really soared in the way you see at major market tops. Who's going to take on a lot of margin debt when you have to pay double-digit percentage rates interest on the margin debt? It doesn't make any sense. So, these are the highest interest rates on these types of products that we've seen in a long time. So it doesn't make sense that margin debt would come back, but that doesn't mean that investors aren't speculating in the markets in a very leveraged way. Look at leveraged ETFs, right? Leveraged ETF assets have soared. And the creation of new leveraged ETFs, 5 times the Magnificent Seven or semiconductors and things, have started trading. And that's even before you start to talk about the prevalence of options trading, right? These 0-day to expiry options, which have just exploded in volume, allow traders to have so much more leverage than they could ever get using margin debt, that I think to say that there isn't the sign of leverage speculation in the market, and you're pointing just to margin debt, either you're being disingenuous or you're just not aware of the extreme speculation that's been going on in the options markets regularly. We've seen it mainly in the semiconductor space lately. Just look at stocks like Nvidia, of course, but more recently, Micron in the last few days has seen its stock price explode. Kind of in line with massive trading in, so far out of the money call options and short dated that expire in a day or two. So, the speculation is there. And I think, valuations have only ever been this high at the peak of the 2020 bubble. We're almost 50% higher on the things like the Warren Buffett yardstick, 50% higher today than we were at the peak of the dot-com mania. So valuations are extreme. We have extreme leverage speculation on the part of traders. And I think that, if we do get this slowdown in the economy, that will be the bearish catalyst for another significant decline in stocks.
Makes sense. So, and what is driving, I guess, the inflows? Is this from international investors? Is it from retail? Is it sort of, as you said, speculation among institutional investors? Is it everything?
I think it's everything. I think we've seen it in retail investors. We've seen it in one of the interesting areas is because Chinese economy and markets have been so weak that Chinese investors were desperate to get money out of China, and were buying a lot of these kind of leveraged, Magnificent Seven products that they have available to them. They were paying as much as a 50% premium to the net asset value of these things. That's how desperate they were, the FOMO, to get into these trades. So I think it's coming from everywhere. I think you can just see it in the commitment of traders reports too. You look at just kind of asset managers in NASDAQ futures. look at small speculators in S&P 500 futures, and we're at record exposure. Really, never before have small speculators been anywhere near as leveraged in terms of long speculation in S&P futures as they are today. It's much bigger than it was a couple of years ago at the 2021 peak. And same thing for asset managers and Nasdaq futures and things. So it's small speculators, it's asset managers, it's overseas investors. It's really coming from everywhere.
Yeah, it makes sense. And I've been looking at a few people talking about, as you said, speculation, not just in markets, but everywhere. So we see sports betting is becoming massive in the US, online gambling. I think there's links to why is the NFL sort of viewership growing compared to the NBA, because they actually have play-by-play gambling. So it seems like there's link, just the whole society is becoming more speculative and not just assets, but everything in general.
Yeah, and it's interesting. I mean, I'm no expert on socioeconomics, but I'm very curious to read accounts of these types of things and what really explains them. But it's not hard to understand why people are desperately buying metaphorical lottery tickets, right? Housing affordability is terrible. People can't afford to get into, buy their first home. We have inequality, wealth inequality, and income inequality that's still terrible, although it seems to be, starting to trend in the right direction. But people feel like without a winning lottery ticket, it's very difficult to make any progress in terms of your social, or economic standing in the world. And so, that's we see it in sports betting, but it's playing out in the markets as well. And it's these speculative types of things that really define a bubble. I think it's my friend Eric Cinnamon wrote a piece that I highlighted in my weekend email this week. That really defines a market bubble is extrapolating the unsustainable, extrapolating trends that can't be sustained. And I really think that it kind of explains what's going on in the markets today. That for Nvidia, for example, to continue its trend would mean that it has to become a multi-trillion-dollar, $100 trillion market cap, sometime in the next 10 years, which obviously is just not possible. But even just for the AI spending generally, and for all kinds of things, for extrapolating U.S. outperformance, right? The U.S. stock market has dramatically outperformed foreign markets for 20 years now. For that to continue would require basically the U.S. to eat the entire world, and that's not going to happen. So there's a lot of these trends being extrapolated, and when you actually think about what they would mean for that to be able to come to pass, it's asinine. And so I think that really is the defining characteristic of a bubble. Are all these kind of speculative sentiments that don't make any rational sense. It's literally just, can I sell this tomorrow to somebody else for more money? And when that's driving markets, that's a clear sign that you're in the midst of a speculative mania.
Hey everyone, sorry for interrupting. I just wanted to extend a massive thank you to you for listening and tuning in, and for your support over these 3 years. So we've had, hundreds of guests that we've welcomed on the podcast. We've had millions of views with hundreds of thousands of different people listening in. So I just wanted to thank you. I started this as a student. I'm now currently working, and I've always done this on the side just because I have a passion for it and I've enjoyed it. And probably similar to yourself, you listen to all these, different YouTube channels and podcasts of people listening to different guests. That's how I started, and I just wanted to sort of take the plunge and be able to have the opportunity to speak to these people, and you've made that happen. So thank you very much. Just myself, don't make any money from this, and it's really a passion project. So thanks for supporting that passion of mine. If you wanted to support the channel, all I ask is if you could like, subscribe, or even comment, positive or negative feedback. I'm always willing to take constructive criticism. I'd really appreciate that. But otherwise, thanks so much. If you can believe it, only 14% of our listeners actually subscribe to the podcast. So yeah, if you can, great. If not, no problem at all. Thanks for listening, and yep, let's get back to the show. Yeah, and it seems like it's putting pressure on, I guess, the asset managers and to try and keep up with them. Because if you're not matching or overperforming, then these investors will just say, well, I could be in the S&P or the Nasdaq and making more higher returns with less fees. So it seems like it's almost forcing everyone to go into these few concentrated positions.
It's a great point. I remember I was, the head trader and co-portfolio manager of a hedge fund back during the dot-com mania. And I remember talking to some investors who had, one in particular who had made a lot of money just day trading, which was a pastime, was the 1990s version of speculating in zero DTE options today. People just became day traders back then. And I remember he had done really, really well. And, I was talking to him about kind of maybe diversifying some of his profits instead of just, kind of leveraging all into his day trading endeavors. And, we were talking to him about our flagship hedge fund and saying, we're trying to put up returns that would, beat the market over the long run. And if we can do something like 20% a year over a long period of time, we'll have done phenomenally well for investors. And his response was not 20%. Wow, that would be amazing. It was, well, if I can't do 100% a year, it's not even worth my time. And I think that is the mindset that drives a lot of this is investors aren't even looking for 100% a year right now with a lot of these call options and things. They want to make $2,000 or 2,000% on a individual trade. And so the psychology is just ridiculous. But you're absolutely right, Anthony, to point out that these ridiculous speculative sentiments put a great deal of pressure on asset managers who, as I mentioned, are more leveraged net long than they've been in at least decades. But it puts a great deal of pressure on them. Like if I'm not shooting the lights out and beating the market and doing these things, I'm losing assets. And so how do you beat the market? Well, I have to own more Nvidia than the market. I have to own more Microsoft, more whatever these Mag 7 names that are working, and less of the names that aren't. And so it pushes them into a scenario where they're magnifying the underlying move in the market, and then they're more exposed to if it potentially reverses. And I think this is where there's so much crowding. Ruffer Investment Management put out a very interesting piece last week pointing out that perhaps never before has the market been more correlated in terms of flows because of these dynamics where you have options creating gamma squeezes that push stocks in a direction that force asset managers to chase. And all of it is driven in the first place by passive investing, which is putting more money, net inflows, put more money into these Mag 7 names, which kind of, so it's all a self-reinforcing thing until it starts to turn the other direction. If it does turn into reverse, there's a lot of money coordinated or leveraged to the same trades and has to trade in the same direction. And that's potentially very dangerous if things, reverse course.
Yeah, it's scary to think what would happen when there's all these massive margin calls and could make it go down a lot quicker. It does seem, if we sort of, before we look at what happens after the bubble burst, but it does seem like it's almost an everything bubble as well, because you look at other assets that are increasing. So do you think this is there's just all this correlation between all assets because of speculation? Do you think there's any other factors that would be influencing it?
Yeah, everything bubble is something I've talked about for 10 years now, right? And so like either you're dead wrong, Jesse, or this is just, how bubbles work, which is they go on a lot farther than you think is possible. And I think that the latter is, demonstrably the case. Right. So the idea about the everything bubble was that because the central bank lowered interest rates, you lower discount rates for every kind of asset class, right? You're lowering cap rates for commercial real estate and and you're lowering mortgages, which make residential real estate more affordable and pushes the prices up of all types of real estate. Obviously, lower interest rates mean bond values go up significantly, but also the stock market too is a discounting mechanism. And when the risk-free rate comes down, that's one of the things that has inflated, probably the most important thing that has inflated corporate profit margins over the last 10, 20 years, is the fact that their interest expenses have come down so low. And so you have inflated corporate profits, and then you have inflated valuations of the equities on top of those inflated profits. And so, yeah, on multiple levels, you could argue that we still do have an everything bubble where so many things are dramatically overvalued. Now, like I said, it comes back to interest rates, and interest rates have not come back down to their lows. Right. I mean, today, we're looking at, interest rates, coming right back up. I think 4.30 on the 10-year yield. And so, right now, a lot of these markets are dependent on interest rates coming way back down. Right. Stock market probably needs real interest rates, especially, as things like you look at yields on tips, right? Long-term tips. They need tips yields to come way back down again to justify current equity valuations. But real estate too, right? If you don't get mortgage rates coming back down to somewhere in the fours or something, you might have a real problem with real estate over the night. And we're seeing it in commercial, of course, right? In offices, especially, where office valuations are falling precipitously, right? Real estate's a very highly levered asset class, and so you get a small decline in prices, and it causes big problems. Now, that's something that's still playing out, but I think if interest rates can't go back down to their lows, that's a real problem for a lot of different asset classes.
Yeah, it's a great point. And do you see the potential of the Fed cutting? I guess it looks like they're going to cut in the next few months potentially. We'll see if interest rates, if inflation remains high. But do you see that being sort of buoying on the market further, or do you think that they'll sort of cut too late to save the market?
It's a good question. I think that typically the Fed, I think what's going to allow the Fed to cut this cycle is a real deterioration in the labor market, right? The problem for the stock market is that a real deterioration in the labor market is a clear sign that the economy is already in recession. If the economy is already in recession, people are losing their jobs. That means corporate earnings are probably going to decline rather than begin to really take off, as analyst expectations point to, towards the second half of this year. So that would suggest that, if the Fed is cutting, it's because it's become more clear that the economy is headed for recession, but also that earnings are not going to come close to meeting analyst expectations for the second half of the year. So I think that would have to be bearish for stocks. And typically, that's what we see during a cutting cycle. As you look back at the last several major cutting cycles, I'm talking about 2008, but even outside of financial crisis type thing, look at the 2001 to 2003 time period. Stock market went steadily down for 2+ years as the Fed continued to lower interest rates, and it was just the fact that the economy was continuing to weaken, even as the Fed was cutting. And so that I think that's more important to stock prices, is what is the trend in earnings, and what are earnings going to look like 18 months from now. And so long as that picture 18 months from now is deteriorating, it's difficult for stocks to go higher. So I think that if the Fed does start to cut this year, it will only be because the labor market is weakened to the point that it's clear that we're in recession. That's obviously bearish for equities and earnings.
Yeah, it wouldn't be good news. So what are you watching to sort of see, I guess, when we could see a reversal? Is it the economic data, as you're mentioning there, the employment, or is there anything else that you'll be watching to sort of know?
The stock market is a really good leading indicator, right? It's so one of the things I'm looking for is signs that the AI bubble is beginning to burst. And I just shared an article on Twitter that highlighted a couple of surveys of Fortune 100 to 1000 companies shows, I think 98% of companies are now putting the brakes on AI investment and AI rollout because they're worried about the quality of the product, the data, there's hallucinations. They're worried about violating trademarks and these types of things. It very much like the early days of the internet. You have a hype cycle, which drives a tremendous amount of excitement and investment, and then that initial hype cycle gives way to the reality of this is going to take a lot more work to figure out how to make it profitable, how to make it more efficient, how we can really benefit from it. And I think that we're approaching that stage. So I'm especially looking at the semiconductor stocks, which I think have been the biggest beneficiaries of the AI thing lately. But I think we've started to see a number of the Magnificent Seven stocks begin to falter. Tesla and Apple have not done well lately, which people take as a sign of confidence. Like, well, if the market can do well without those names, then that's a great sign. I take it as you're losing more of the leadership of the market, and if the semiconductor stocks start to give way, that would be a clear sign that yes, investment in the AI space is starting to slow. And when you have things that are priced for exponential growth, just small changes, downgrades to that growth result in big changes to the present value of those assets. And so I think if we start seeing downgrades of the future growth estimates, that could be enough to play catalyst for bearish reversal.
Okay, that makes a lot of sense. And yeah, as you said, Nvidia seems to be the main driver at the moment. So I guess that would be the main one to be watching.
Yeah, I mean it's really the Magnificent Seven stock that has driven most of the gains recently. I'm looking at a variety of AMD is another one. ARM is one that's done well. I mentioned Micron, and Micron is one that I think my friend Fred Hickey has pointed out that one thing investors are forgetting, and this is the case in the history of Nvidia, this is the case in the history of Micron. In all of these stocks that have become fan favorites, is their history of these stocks is boom bust. None of them have seen booms that just went on forever and they became fabulously profitable and growth forever. They go through boom bust cycles because of the supply demand. The way these things work is you get over ordering, right? There's the boom in the hype cycle, so then you get over ordering and double triple ordering, whatever, and then people realize, oh, wait a second, I got all the product I need, I'm canceling those orders. And so then you get a bust. And this has been the history of these stocks for literally decades now. And so, people are, as I said before, extrapolating the unsustainable, and in a lot of ways, and especially in the semiconductor space, that the growth that some of these stocks are seeing over the last several quarters cannot be sustained. It's impossible to sustain. So when that starts to become evident and we start seeing that, wow, growth is really decelerating, that could be the trigger for a reversal in this hype cycle in the AI space.
Yeah, it's a good point. It seems like it's the large companies that are actually sort of doing an arms race at the moment. So the Googles, the Metas, the Amazons, they're all buying the chips. So as you said, if there's for any reasons they have challenges, that's going to sort of mean they're going to order less, and then permeating.
Well, and the real problem is, as Sequoia, VC firm pointed out recently, and just in the last couple of quarters, these major companies have spent $50 billion on Nvidia chips, and so far they've generated $3 billion in revenues, on that investment. So, generating $3 billion in revenue on a $50 billion investment doesn't even come close to cutting it for these companies, and not, especially in terms of investor expectations for what these companies are going to be able to generate with this investment. So I think it's already clear that it's hurting free cash flow at a lot of these companies' names. I mean, the Magnificent Seven stocks trade 50 times free cash flow right now. You just aggregate all their market caps, aggregate all their free cash flow, 50 times free cash flow. So that's what's priced into these companies, that free cash flow is going to grow at an astronomical rate over the next several years, right? If free cash flow doesn't, if these companies can't monetize all that capex, there's a real problem down the road for these stock prices.
Yeah, when the investors start worrying about the return on capital employed, that's when when they'll start pulling back. And there's only so many employees you can cut to still make up 50 billion
Right.
of capital.
Right. Absolutely.
Yep. So then once this happens, are you looking to, I guess, how are you looking to position yourself for such an event? Is it sort of a short? Is it maybe rotating into, I guess, risk off opportunities? What is your thoughts on that?
Yeah. Well, I have been, for several years now, um, talking about and positioned for a commodities super cycle. I think that, I mean, just look at the demand for energy, right? Even if AI doesn't really take off, demand for data centers and these types of things is creating literally exponential growth in demand for just energy. How are we going to produce all of that energy? It's going to come from either nuclear or probably more likely natural gas. And so all these natural gas stocks trade at incredibly cheap multiples. I mean, they've done really well over the last month or so, starting to come back. But look at the oil price. I think that it's very clear that we've had dramatic underinvestment in the commodity space generally for a number of years now, which means supplies are constrained at the same time that demand for, as I mentioned, energy, but a lot of other things. I mean, we look at Chinese have been buying up like massive amounts of copper recently. Their economy is starting to do well. Demand for commodities continues to surprise on the upside while supplies remain constrained. To me, the long-term investment case for commodities producers is very, very bullish. And so I like things in the energy space. And then precious metals have done very well recently too, obviously, and that's merely a function of, I think, the fact that inflation is not coming down to target, and the Fed is still talking about cuts. And so I think it's pretty clear that the Fed is changing its tune regarding the inflation mandate. And if that's the case, as investors kind of come around to that idea that, wait a second, maybe the Fed doesn't have our back anymore. Maybe the Fed isn't going to make sure that inflation comes down, allowing for interest rates to come down. That's not only a problem for the stock market. How do I protect myself if inflation is going to remain elevated for the next 5-10 years? I need to own commodities. I have to own things like energy stocks. This is why Warren Buffett has been selling off everything in the portfolio except for Occidental Petroleum, right? I mean, he's showing you what he's doing, but it's the same thing with precious metals. And so, if I need to protect myself against inflation, I need to own some gold. And institutional investors dramatically underinvested in the commodity space and precious metals and these types of things. And in an inflationary environment, these are the best things you can own to protect yourself. So I think we're going to witness a shift towards more of those types of asset classes. And I think the moves that we've seen in the last month or so in that space is just the beginning of a bigger trend.
Do you think in the short term, I guess, if the economy does go into a recession, then that could potentially impact commodities as well?
I mean, that's why people have shunned energy for the last 12 months. Is because people thought, okay, if we go in recession, energy's gonna suffer. But the Chinese economy is a much bigger deal in terms of commodity demand than any others. And there's also, we could go into recession, but how are we going to deal with it? Well, a lot of these protectionist policies, the Biden administration and Congress, supporting, the reshoring of production, right? It seems like this is kind of a bipartisan thing, is that the offshoring of labor over the last half century has caused all kinds of problems. It's not politically feasible anymore. we need to bring that production back home. So even if you do see a recession in the economy, I think it's more likely to be that kind of stagflationary type of thing like we saw in the 70s, where nominal GDP growth never fell below 5% during the 1970s, right? Nominal GDP remained strong. It was only that inflation rose up faster than nominal GDP growth, so you got that negative real number. I think that's probably more likely what we're to see in terms of recession. If we do get one, is nominal GDP growth continues to grow, pretty strongly. It's just inflation picks back up, and you see a decline in real growth. And so, if you see that at the same time as the Chinese economy continues to reaccelerate, I think it's really tough to make a bearish case for commodities.
Yeah, it's a good point. So maybe if I focus on natural gas and I have sort of some insights into it, there is concern that there's going to be a sort of a production glut in the end of the decades, I guess 2026, 2027 onwards, with more supply coming online in the US and Qatar. Are you concerned about that, or do you think maybe the latent supply, so as the price goes down, sort of India and China are sort of going to be more larger buyers of that moving forward?
I think this is another case of extrapolating the unsustainable, right? So on the bullish side, investors extrapolating, growth in AI investment and productivity and all these things that are just not supportable by, rational analysis. At the same time, I think investors are extrapolating growth in oil and natural gas supplies like we've seen over the last 10, 15 years, which is totally not sustainable. Right, the U.S. has been the surprise, growth in production and supplies over the last, 10, 15 years or so. But as my friends at Gehring and Rosenzweig have pointed out, the Permian basin is probably getting close. I mean, and that's where the real growth left in the U.S. is potentially getting close to peaking in terms of its ability to produce. If that's the case, then the supply forecasts over the next several years are going to turn out to be vastly over optimistic. I think there's probably a case to be made, and they've made it very well in their recent research, that supplies will be much more constrained. And this is probably why you see a lot of these natural gas companies recently coming out. I think Chesapeake was the latest to say they're going to, they're drilling wells, but they're not going to start pulling product out of the ground. They're going to leave it in the ground as essentially as investment in storage in the ground, because prices are just don't make any sense. And so I think if you have these types of shut-ins going on at the same time that production over a number of years is likely to be constrained, I think probably the bear case for natural gas is overstated. That remains to be seen, but I think that one of the things that I look at is the insider buying in this space, and executives at these companies have been very bullish on their own shares for the last year or so, and I think that's a sign that they think that natural gas prices are unsustainably low right now, and that the future is very bright for these companies as they are able to export more product overseas in terms of liquefied product, and as supplies start to become more constrained.
Okay, yeah, that does make a lot of sense. So Jesse, thanks so much for your time today. Really appreciate it. My last question is, what is one message you'd like people to take away from our conversation?
Oh, I don't know. I mean, think for yourself. I think that that's one of the things that I try to do is I read a ton, but I don't take any of it at face value, right? I mean, I think think for yourself just means read things, but ask yourself, why am I reading this now? And does this reflect sentiment more than reality, or how much of this is already reflected in price? And so it's basically just, as I think Howard Marks has pointed out, there's a difference between first level and second level thinking. First level thinking is taking things at face value. Second level is, read a lot, educate yourself, but then also think about, how is this priced in or not priced into the market, and how does this reflect the reality of the situation versus reflect the sentiment in the market currently. As my friend Peter Atwater likes to say, media reflects mood. And so if you're following the media and just reading and basing your investment decisions on what you read in terms of first level thinking, you're going to be bullish at the top and bearish at the bottom, and it's not going to serve you very well.
Yeah, never a place you want to be. But yeah, Jesse, thanks so much. If anyone wanted to find out more about your work and what you do, where would the best places for that be?
My website is thefelderreport.com. I put out a free blog post every week. It's basically just curating 5 things I found during the week. This last week was 5 articles essentially that I found especially compelling, but sometimes it's charts, statistics, tweets, interviews, podcasts. So you can sign up there for that on my right on the homepage of my website. I'm also active on Twitter. It's just at Jesse Felder. And I try and post there a lot of the interesting things that I'm finding and reading during the week.
Perfect. I'll put that in the description below. But thanks again for your time.
Thanks, Anthony. It was fun.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment. Good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right, thanks again.